Ken Shinoda, portfolio manager over at DoubleLine Capital, flying all the way in from California just to see us here in New York. Ken, great to have you here.
Thanks for having me.
Were you surprised?
Not really surprised. I think that they were so behind the curve, hiking rates when inflation had picked up, that they wanted to tell the market that we're not afraid to cut. And so I think they did the right thing by cutting 50 basis points. It was kind of priced into markets this morning. And I think why equities have pulled back a little bit is while they cut 50, they're still data dependent. And they didn't get too dovish in his remarks.
Mm-hmm. Well, I'm curious about that, too, because when we talk about what the market expectations are, I mean, they gave some projections in that dot plot that seem to suggest they're going to be relatively aggressive with additional rate cuts going forward here. And I'm wondering why the market didn't find some solace in that.
Yeah, they're projecting another, call it 50 basis points through the end of the year, so we'll get another 25 the next two meetings, and then 100 over the next, through 2025. And I think maybe the market wanted to hear some more dovish language on we're going to get back to neutral quicker. They also moved the neutral rate up a little higher. Their estimation of the neutral rate moved up a little bit, so maybe that has something to do with it, too.
Like 3.4%, right?
Yeah, but it was interesting, though. I mean, 10 officials still see 100 basis point cuts or more. 9 see 75 or less. So it's still really wide for this year. So what do you do in the market? Like, is this a good time for corporate credit? Like, do you just sit tight on where you are in the curve?
Well, I think a lot of people have been hesitant to move back into the fixed income markets. They've been sitting in the T-bill and chill, and you got to start coming out the curve. I know the rates have rallied, and the last couple times we've been on, you've said, what do you recommend investors do? And I've been saying, you got to come out the curve. Maybe you don't want to go all the way out to the 10-year. Come out to the 2-year. The 2-year was at 5% not so long ago. Now it's down to 3.5%. So you got to start increasing that duration of your portfolio. The timing isn't that great since we're at the lower end of the trading range, but you're never going to time the bottom perfectly, just like you won't in equities. So you got to start legging into more fixed income into your portfolios.
What about the corporate bond market?
The corporate bond market has had a great run from a spread standpoint. It's tightened a lot. It's very high quality, but just from a spread standpoint, it looks a little expensive, but I'd rather be there than in some of the riskier parts of the market. The credit curve has flattened a lot, meaning the yield pickup to go buy something riskier, like CCC high yield, for example, has come down a lot. So you're not getting paid that much more to take more risk. So I do like staying in the higher quality parts of the fixed income market.
Can you sort of elaborate on that as well? Because we're hearing the same thing from folks in the equity space saying, yeah, we're going to stay invested, but we're gravitating to things that are a little bit more safe or defensive or boring, I think is what one of our guests called it earlier this week here. But what does that mean? I mean, in terms of, because if it's not just the shortest of short-term duration in terms of, you know, doing NT bills and other money market type instruments, then where do you find that safety?
Well, high quality can also be out the curve. 10-year Treasury is high quality. It's government guaranteed. You could pick up additional yield by going into
locking in for 10 years or taking that with the idea that
I'm just saying you can buy Treasuries to get high quality exposure.
Gotcha.
On top, the next step would be going to things like government guaranteed agency mortgage-backed securities. You get paid some spread to take on prepayment risk, and those look really cheap relative to history. And investment-grade corporate bonds are another tool in the toolkit for investors where you can pick up a little bit of spread, but you're not really taking a lot of credit risk. I also don't mind the higher quality parts of, for example, high yield. Double B high yield, there's still pretty good quality companies. If you do your credit selection, you can pick up some additional spread there, and you're not going to the junkiest parts of the market.
When you look at past easing cycles at the start of it and the reaction that you got, let's take agency MBS, for example, mortgage-backed securities. Do you think we're going to see a similar repeat of those moves, or has that market changed so much from the previous easing cycles or major easing cycles that we saw?
No, I think agency mortgages had been the value trap in fixed income for the better part of 2 years up until the last few months. They had just continuously lagged treasuries and corporate bonds, and really part of the reason was the rates were so high, and a lot of investors need the short-term rates to come down to buy these assets on a levered basis. As the Fed cuts, this is the best environment for those assets. So I think we're going to see continued performance out of that and fixed income broadly. I do think we ran a little too far too fast. We're going to see a little bit of a pullback potentially. You're already seeing it today. Use that as an opportunity to add some more fixed income into your portfolios.
Yep, looking at the 10-year at 3.7 is where we sit right now. Before we let you go, how do you trade the next data point? And like, what is that now?
Well, per Powell's comments, I think it's a lot of it's on jobs, right? We want to see what's going on with the labor market. To get more aggressive cuts than they're talking about, we need to see a more rapidly cooling labor market in order to get kind of more aggressive views from them.
All right, Ken, great to have you. Got to
All right.
leave it there. Ken Shinoda, portfolio manager over at DoubleLine Capital.